Mr. Reese Chipman, Member of Parliament for Centerville, senior government officials present, Excellencies, Governor John Roll, Central Bank of the Bahamas, Mr. President of the University of the Bahamas, Dr. Rodney Smith, Madam Provost, Dr. Linda Davis, other executives of the University of the Bahamas, Mr. Chairman of the Board of Directors of the University of the Bahamas, Dr. Trustees, John Rogers, Dr. Rogers, and other members of the Board of Trustees, distinguished panelists who will be introduced later on, UB executives, faculty members and staff, ladies and gentlemen, good evening.
Good evening.
I welcome each of you to this, the first of many events that the Government and Public Policy Institute here at the University of the Bahamas will host in the years to come, as it seeks to promote thoughtful dialogue on matters of public policy in this country. Combined with our aim to provide research, training, and consulting services on public policy matters relevant to the Bahamas and the region, we seek to contribute significantly to the growth and development of our nation as a center of excellence here at the University of the Bahamas. My welcome extends to our audience in Grand Bahama, hosted there by University of Bahamas North Campus under the leadership of Dr. Ian Strawn, where they are gathered in the Starfish Room of the Pelican Bay Resort, joining us by Zoom. I also welcome our audience tuning in here at home and all over the world via the internet on the University of Bahamas' Facebook page. Tonight we have gathered in this place all of the past governors of the Central Bank of the Bahamas, with, of course, the exception of the founding chairman of the Bahamas Monetary Authority and founding governor of the bank, the late T. Basil Donaldson. These former governors are Bahamians, saving for Mr. Donaldson, who have set the foundation and laid the framework for the monetary policy of the Bahamas to date, and who have coordinated its harmonization with the fiscal policy of the country. Tonight, in this unique and historic forum, they will speak to and field questions about the evolution of monetary policy and fiscal policy, its present status as they see it, and its future prospects. They are fully qualified to speak to each of these issues, and I fully expect that they will. Before I introduce our distinguished panelists to you this evening, let me thank President Dr. Smith and Provost Dr. Davis and their staff, University Relations, Mr. Antonius Roberts, and UB North staff for their tremendous support in our effort to host this event. I especially thank the staff of the Government and Public Policy Institute, Jeannie Gibson, our assistant analyst, and Marcia Smith, our administrative assistant, for their dedicated work in organizing this affair. Before we get to what I'm sure you have all come to listen to, I want to now invite the president of this great university to come and address us, Dr. Rodney Smith.
Good evening. I won't be long because I know I'm not the person you came to listen to. You came to listen to some distinguished speakers this evening. But I just wanted to say a few words. Yesterday I had the privilege of participating in national policy discussions in Washington, D.C. pertaining to international students in the United States. And one of the things we talked about, in addition to national security reports and FBI reports, was what's going on in terms of public policy in China, what's going on in terms of public policy in Canada, what's going on in terms of public policy in African states, And it made me realize that, when we talk about public policy here in the Bahamas, we need to talk about public policy in relation to what is happening around the world. Otherwise, we're going to get buried somewhere along the line. And we need to be very, very serious about that. And I do want to commend Mr. Laing for pulling the first forum together. And allow me to begin by just reflecting a moment. On November 10th, 2016, the university became chartered, and in so doing began the redefinition of tertiary education in our beloved Commonwealth of the Bahamas. The university pledged then to adopt academic structures that would allow the university to be responsive to national needs and research opportunities. In 2016, and even today, the nation remains underserved when it comes to scholarly research, analysis, and commentary on matters of national importance, such as the economy, educational reform, tourism, environmental policy, and our national politics within wider geopolitical arenas. To ensure that the university maximizes its potential to support and drive national development, this Center for Excellence, the Government and Public Policy Institute, was established and became institutionalized in 2017. The Institute is committed to seeking research and consulting opportunities, particularly in service to public and private sectors. In addition to several other major initiatives pertaining to national development, this Center of Excellence aims to foster critical inquiry, discourse, and engagement around public policy matters through publications and other media, seminars, lectures, and other fora. This evening's event is one such forum. Tonight, under the guidance of the Executive Director and Senior Policy Fellow, Mr. Zhivargo Laing, UB's Government and Public Policy Institute will hold a first in a series of public policy fora. Tonight, 4 former yet prominent Central Bank of the Bahamas governors will give their views on monetary and fiscal policies within the Bahamas and, expectedly, within the several wider global geopolitical arenas. It is my hope that this forum will serve to encourage students to consider careers in public policy, government, and law. Our university has created avenues of opportunities for students and the public to become engaged and to receive knowledge through such fora as our Government and Public Policy Institute. I encourage each of you to listen attentively and participate in the discussions that our panel of experts will share, and to leave here with much food for thought. Please know that you are always welcome here to the campus of UB, the most beautiful campus, I believe, in the region. Thank you.
Thank you, Mr. President. Talk about standing on the shoulders of. We also have the privilege this evening to have in the audience with us and to bring remarks on this occasion the present Governor of the Central Bank of the Bahamas. Ladies and gentlemen, please welcome Mr. John Rule. And a graduate of the College of the Bahamas, now University of the Bahamas.
Good evening. It is a pleasure for me to bring opening remarks for this distinguished panel of past Central Bank governors, all of whom I have known and worked with in some professional capacity. The common theme in these professional encounters was the appreciation for the scope for which monetary policy could be effective in either a Bahamian or Caribbean setting, what contributed to making policy effective, and the understanding of what constrained policymakers. In the Bahamas, we have a commitment to maintain a fixed exchange rate at 1-to-1 against the United States dollar. The exchange rate peg is supported by the foreign reserves of the central bank, and by law, the currency liabilities of the bank must be matched at all times by at least half the equivalent amount of foreign reserves. At present, the central bank tries to target this coverage in the range of 90 to 100%. For the peg to be credible, the bank must always be able to supply foreign exchange at the guaranteed exchange rate. Under our exchange control regime, this guarantee is binding for all trade and current account transactions. To ensure credible access to foreign exchange, the bank seeks, therefore, to balance inflows principally from export earnings against demand stimulated outflows from income, drawdown on savings, and domestic credit finance activities. The level most commonly controlled by the central bank is domestic credit, and it is focused not on whether credit can stimulate economic activity, but on whether credit generated can be sustained, given the first imperative to maintain adequate external reserves. In the aftermath of the September 2001 attack on the United States, the optimal policy response was to freeze the supply of domestic credit and to tighten lending standards. This was a contractionary or pro-cyclical policy response. When the foreign exchange inflows improved, credit conditions were relaxed, also in a pro-cyclical fashion. This episode illustrated what is generally the case for the Bahamas. Protecting the value of the Bahamian dollar leaves little sustainable space for monetary policy to be growth-enhancing in the short run. Developments in the fiscal domain also affect the monetary policy stance. As a general proposition, it is neither advisable nor sustainable in a fixed exchange rate regime to have unchecked deficit financing by the monetary authority. These can perpetuate currency-based expansion without the corresponding increase in the foreign reserves that provide the coverage for the currency. Fiscal deficits can also fuel increased imports and draw down on foreign reserves. At the instance of a deficit, monetary policy is therefore most concerned about how the deficits will be financed. The reference point is not the amount of domestic liquidity against which the government can borrow, but the amount of foreign exchange that the economy would be required to pay for the resulting increase in import demand. Given this consideration, the central bank's advice is usually that deficit must be financed with some amount of foreign borrowing. Otherwise, the effect would be a drawdown on foreign reserves and undermine support for the currency. The preventive measure is limiting the occurrence of deficit in the first instance, as often the choice of how the deficit will be financed is an artificial one. There is nevertheless a medium-term concern about the level of liquidity in the Bahamian financial system. To address this, the central bank's forward-looking strategy is to gradually reduce the outstanding lending to government. This would absorb any excess liquidity in our system that had its origination in accumulated past financing of the government. Where does all of this leave us in terms of improving the environment for monetary policy and making it less pro-cyclical? First, over the medium term, the economy has to do a better job of retaining the foreign exchange that it earns. More bank lending has to reach productive enterprise activities that forge linkages with tourism, provide competitive substitute for imports, stress on competitive substitutes, and expand our export reach. That is, competitive substitutes for imports. The central bank's targeted liberalization of capital controls has also allowed such categories of enterprises to have direct access to financing and foreign exchange. We believe that this is a strategy that will bear fruit over the medium term. Second, the fiscal policy framework has to bolster support for the currency. Deficits, when they arise, should anchor public investment with positive net returns to economic growth and have a positive foreign exchange bias. More fundamentally, for our present circumstances, deficit reduction and eventually budget surpluses should become the order of today, with more public investment sustained from savings on recurrent expenditures. Fiscal deficits and debt accumulation can make it difficult to wean the government off borrowing from the monetary authority, and in parallel, they can expand foreign currency debt in ways that cannot be easily repaid. Better foreign exchange retention and confidence engendered by fiscal policy takes us to the topic of exchange controls. Here, some rebranding is necessary to make this more of a conversation about capital controls and capital flow management, because this is essentially where our policies are currently more binding, but where scope for gradual targeted easing is possible over the medium term. The limit, though, is to understand that liberalization cannot happen out of a sequence of having first in place lasting policy and accountability framework that bolster confidence. Where these frameworks are missing or nascent, liberalization must impose a distinction between how we deal with investments or direct investment versus very liquid and highly sensitive portfolio flows. If the end goal is to have a fully liberalized capital account, then we must accept that it would come with a floating Bahamian dollar. If we float, we should want to avoid the exchange rate volatility that arises when investors become jittery. If we dollarize to eliminate the currency volatility concerns, then fiscal and private sector savings will still remain important to provide the buffers needed to make our economy resilient. Dollarization will not provide a shortcut out of the reforms that are needed in terms of utilizing less direct means of influencing credit and investment behavior to safeguard financial stability, in terms of having more comprehensive real-time data on economic activity, including fiscal indicators, or in terms of having a larger stock of foreign reserves to cushion against shocks. Dollarization would still be premised on a target value for the exchange rate at the time at which the domestic currency was abandoned. This again raises the question of whether such an outcome could be achieved absent an effective capital flow management regime. There's much more that can be said on this topic and on other dimensions of the central bank's role beyond the protection of the currency. The bank has been working tirelessly in all of those dimensions, strengthening the quality of our regime for supervised financial institutions, accelerating the modernization of the domestic payment system, laying the foundation for use of more indirect monetary policy instruments, and building more capacity for macroprudential supervision. We realize that it is only through lasting structural reforms that there will be progress in making the monetary and financial system a stable, more resilient, and a less pro-cyclical component of our growth and development. It is fitting, therefore, to have this esteemed panel assemble, and I look forward to hearing their views on these important topics. Thank you.
Which notes, I might add, is posted to the website of the central bank. Yes, so you can have access to it. No doubt the governor has provided lots of food for thought and commentary tonight. So let me give you a little roadmap as to how we are going to proceed. We are going to have each panelist provide a 5-minute opening statement, and then we will launch into a moderated question and answer period. And following upon that, we will open up the floor for questions from yourselves and from our audience in Grand Bahama. Fair enough? I do want on this occasion now to recognize present with us today the Minister of Agriculture and Marine Resources, the Honorable Michael Pintard. Thank you very much for coming, sir. He is the most senior of the panelists here in terms of tenure when at the bank. Sir William Allen joined the Bahamas Monetary Authority as Manager of Research in 1970. He was named the Deputy Governor of the Central Bank, which was the successor to the authority, in 1974. He became governor on 1st June 1980 on the resignation of Mr. Timothy Boswell Donaldson from the post. Following an extensive career in banking and finance, Sir William went on to serve in the government of the Bahamas as Minister of State in the Ministry of Finance and Planning, and subsequently as Minister of Finance and Planning. In 2000, Sir William Allen was made a Knight Commander of the Most Excellent Order of St. Michael and St. George. I am going to now ask Sir William Allen to come and to make his opening statement.
Good evening all, and I'm going to rest on the protocol already established. I trust that'll be fine with everybody. I'm glad I'm up first because I took some liberties, with this presentation. I didn't do a historical thing. I used this to sneak in some thoughts that I have in my head, And I hope they don't run me out of this room. There you go. And now you can tell that I'm dated. I'm old-fashioned. I see all my colleagues have their little tablets, their little. I don't have that. I have one, but it doesn't travel easily with me. So first, I should like to say how delighted I am at the establishment of this Government and Public Policy Institute. And I congratulate you, Mr. Laing, as its first executive director. I have no doubt that the Institute will be an enormous agent for leading high-level debate on important matters of public policy. That you have chosen to focus your first public event on monetary and fiscal policy in the Bahamas could hardly be more timely and relevant. There is, of course, as you all know, a fairly considerable public debate already occurring, and our sense is that in due course we shall be approaching what I call some important point of reflection, of inflection in the arrangements of public revenues. Now I leave it out there and you can make out what you wish. So to involve the intellectual and discipline and rigor of the Institute in this debate would surely be a benefit to the soundness and depth of the debate. I will recall at the establishment of the central bank how circumscribed were the institutional arrangements for public policy debate, yet how urgent that debate would have been. But we were then at the creation stage of an independent nation. And understandably, such debate would have been mainly driven by international institutions like the IMF and the World Bank, that we had just become members of. Our policymakers and our public could easily have been overwhelmed by the breadth of financial internationalization, that was bearing down on the financial infrastructure in a very brief period. In fact, in 1974, so the establishment of the central bank, the establishment of the Bahamas Bahamas Development Bank, the coming into operation of the National Insurance Scheme, the first public issue of government bonds, which represented the beginning of a capital market, a public capital market, reorganization of the Post Office Savings Bank, and provision was made for the regulation of hire purchase. This was intended to provide some protection for consumers in hire purchase credit, and it was felt then to be needed. It was a period of significant financial institutional transformation for a small economy with no income tax, more banks per capita than anybody else, and seeking necessarily to find its place in this great scheme of things. I believe that it can generally be agreed that the broad objective of both monetary and fiscal policy is to ensure the continuous growth and stability of the Bahamian economy. I know some intellectuals will have some difficulty with that. And by this, to ensure the progress of social development, higher levels of employment, and higher living standards for all Bahamians. That, I believe, is the broad objective of both monetary and fiscal policy. Over the years, the comparative performance of the Bahamian economy among its regional counterparts was rather impressive. In point of fact, comparison of economic performance and development to some more advanced European countries with similar per capita incomes has also been impressive. Our early economic development was considerably driven by a successful combination of the provision of international services to both onshore and offshore markets in a way that attracted huge levels of foreign capital and provided high levels of domestic employment. This was supported by a domestic fiscal policy that most of our competitors were unwilling or unable to try. We were therefore always answering the question, how will you fund your public finance? There is no question that we built a comparatively vibrant economy on that fiscal arrangement. At a cost, of course, to ourselves. The problem for us now is in determining when that strategy will have exhausted its usefulness and how to dismantle a policy that has essentially become a part of the culture, even though aspects of it defy logic. Your institute will, no doubt, at some point, engage itself in that debate. We are variously said to have a debt crisis or a fiscal crisis, and for those of us taking the longer perspective, it is difficult to accept the crisis concept in its fullness. When it is recognized, when we recognize, see, I don't see very well, so I'm trying to find light here somewhere. I was saying it is difficult for some of us to accept the crisis concept in its fullness when it is recognized that we have been funding a developing country with about 15% of national income, depending on how one views the reliability of the measurement of national income. But let me say it again. We have been funding our national development, our governance, by about 15%, I would say, but those are 16, sometimes 17, sometimes 18 sometimes, 80% of national income. It is not likely happening anywhere else in the globe. There, that we have actually achieved some respectable level of national development by this method is remarkable. And truly, for us, the real crisis may be that we have achieved so much with so little that our argument for change will be undercut, but the case for change, I assure you, is real. Although it is far from perfect, the Human Development Index can be a useful proxy for the status of development for comparative purposes. And the United Nations Development Programme's Human Development Report, released in September this year, based on data collected in 2017, places the Bahamas third in that North American and Caribbean group of countries at the high level of national development, at very high level of national development. And the group of countries calling themselves North America and Caribbean, there are 4 countries. United States is 1, Canada is 1, United States is 2, Bahamas is 3, and Barbados is 4 in that category. The Bahamas is placed 54th of the 60 in the global very high human development index. Now, that's the index for the globe, for the entire world. There are 50 of 60 countries in there. 54. 60 countries. And I would argue that there is no reason the Bahamas could not significantly exceed its position on the global index, on that global index, with little tinkering on the edges of its fiscal affairs. Now, I take issue with much of the criticism of level at the Bahamian economy, most of the time, especially regarding its lack of diversification and a perceived weakness in its revenue-generating capacity. On a per capita basis, it is difficult to imagine a more diversified economy than the Bahamas, with its very, very large-scale tourism facilities, a very large scale in the transshipment operation, very influential financial services, one of the largest ship repair facilities on earth, a domestic aviation industry with 7 independent airlines, and a myriad of small and medium-sized services that support the rest of the economy. And then, of course, the public sector, which here, as elsewhere, is almost always the largest economic activity. But it is difficult for me to understand the concept of the Bahamas, the Bahamian economy needing to diversify. The appropriate thing now is to compare the Bahamas with a comparable size North American city. I've looked at Bakersfield in California with a population of 380,000, whose largest employer is the county government, employing over 7,000 people, whose largest private sector employer consists of 2 farms with combined employment of 5,500. Some oil operations employing about 2,000 or so, and a hospital employing 1,400. There are several small operations in Bakersfield, providing some level of employment, but real employment, total employment, is about 30,000 in Bakersfield. But there is unlikely to be a drive for economic diversification in Bakersfield. But can you truly say that the Bahamian economy is not diversified? Now, the other criticism I have, or I don't agree with for the Bahamian economy, is that its revenue generating capacity is low. I need only note that an economy with a per capita income somewhere around 33,000, it depends on how you measure GDP and the population, clearly has no difficulty generating revenue. An economy that generates that kind of revenue, that kind of per capita income, forget its size, it really doesn't have a problem generating revenue. When this complaint is raised, it is more to do with how that revenue is best accessed by the public sector, which goes to the heart of the fiscal debate, quite frankly. Now, I simply want to make those few points that I think some people might find controversial, and I'd like to join in with the debate. Thank you very much.
Well, I didn't know it was going to get started this early. The next gentleman, distinguished gentleman on the list of seniors there at the bank in terms of when they began their work and did their work at the bank is Mr. James Smith. Please, ladies and gentlemen, welcome Mr. Smith.
Distinguished ladies and gentlemen, since Sir William took some of my time, Like Henry VIII must have said to his wives, this will be brief. Governments everywhere in this modern world employ some form of fiscal and monetary policy as a means of attaining orderly development for their respective economies. The process of collecting taxes from citizens and visitors and spending the proceeds on education, health, law enforcement, etc., is essentially the government's fiscal policy. Here in the Bahamas, total tax revenue is somewhere in the region of $2.4 billion, or about 19-20% of GDP. That is the value of all goods and services produced in this country in a single year. It's an important statistic to keep in mind for our discussions following these opening remarks, because it means, therefore, of an economy of about $11 billion, the government sector represents about 20%. And when we discuss what the government is doing or not doing, we keep forgetting about the other 80% that, is responsible for all the rest of the development. So it's very important, if you're trying to discuss fiscal and monetary policies, there's an inherent limitation to what it can do in an economy. Monetary policy, on the other hand, in the Bahamas, speaks to the way in which a government agency, the Central Bank of the Bahamas, manipulates the money supply, interest rates, buys and sells government debt instruments, that's treasury bills and registered stocks, in order to meet its statutory mandate to ensure stability, orderly development, and best practices in the financial system. Again, in the Central Banks Act from 1974 and all amendments going forward, it has a peculiar mandate to keep economic stability. Translated in our context is the parity between the US dollar and the Bahamian dollar, and that in itself drives fiscal policy to some extent, and always monetary policy, as long as we maintain this fixed parity. In theory, sound fiscal and monetary policies working together in harmony should produce positive economic results such as low unemployment, low inflation, economic growth, a fair distribution of national income, and ultimately a reasonably happy population. As you are well aware, it doesn't always work out that way. So one has to ask, is the theory wrong, or is it being applied incorrectly in the Bahamas? We might shed some light on this mystery later tonight in our discussion, because I'm joined with some distinguished panelists, much smarter than I am. When it comes to applying universally accepted economic principles to the Bahamas with respect to both fiscal and monetary issues, I think it's important to note about four really, in my view, important items, characteristics of the Bahamian economy. One, the Bahamas has a fixed exchange rate pegged to the US dollar, and it also permits US dollars to circulate freely in the local economy, which means that that particular freedom affects your money supply. If the central bank produces or said that money supply should be $100, to control what happens in the economy, the central bank has no real control over the other $50 that may be US dollars circulating concomitantly with US dollars. So it limits again the effectiveness of the bank policy prescription in that particular area. The second one is our economy is extremely open in that approximately 85% of all goods and services consumed locally are imported. So it's really import dependent, and consequently changes in the prices of imports could affect your price levels here, even though you're doing all the right things. Thirdly, non-oil exports from the Bahamas represents a very small percentage of GDP, maybe less than 5%. So we don't export a lot of things. And this has some implications for our ambitions in joining the WTO, because WTO essentially opens markets and flowing goods across borders, but we have very little to send in exchange for what we are importing. And fourth, which perhaps is most important in terms of our budgetary impact, we live in a hurricane zone, so you can have the perfect economic policies, monetary and fiscal. And any time between June and November, a hurricane by any name could wipe out about $400 million off your GDP. And you've done everything correctly. So we have no control, total control, because of our external events, our trading relationships with the United States, our open economy, and basically an act of God, a hurricane. So taken together, these factors would tend to challenge the orthodox application of standard fiscal and monetary policies used in developing countries, at least those that are used in the developed countries. And I think, therefore, to be effective, the local authorities must utilize policy means and methods that are most suitable and appropriate to local conditions if we are to have any chance of implementing a medium to long-term economic development strategy. And I hope tonight in the discussion we might touch on some of those things that fit our peculiar conditions here in the Bahamas. And I thank you very much for indulging me.
Mr. Francis was appointed to the post of Deputy Governor and member of the bank's board of directors in 1993. And following a successful banking career in Paris, France, and early in the Bahamas, Mr. Francis was appointed governor and chairman of the board of the Central Bank of the Bahamas on 1st February 1997 and remained in that post until 2005. I'll now ask you to join with me in welcoming Mr. Julian Francis.
First of all, I would like to thank Dr. Smith and Mr. Laing for putting on this seminar, I would term it, this evening. I think we'll see as the evening's discussion goes that we really need to do a lot more of this. And so this is a wonderful beginning. Thank you for giving us, the former governors, the privilege of being part of this first exercise. As Governor Smith said, Sir William took some of my time also. But I think Sir William laid the background and foundation, and consequently it's going to be possible for me certainly to be able to go fairly quickly and touch on some points which I'm sure we'll come back to as the evening goes on. When I'm thinking about what this discussion this evening means for the Bahamas, what comes to my mind is a song which I think some of us remember by a singer. I don't remember her name, but the title of it is "I Hope You Dance." And the idea, of course, is that you can't live without pushing the boundaries a bit. What I get asked most, I would say, when I talk to people about currency issues is dollarization, the risk of devaluation, the difficulty of Bahamian businesses, particularly, to be able to access foreign currency capital, and generally what is perceived to be the constraints on young Bahamians in particular as they seek to enter the economy and to find their careers, and in some cases, and maybe many cases, business opportunities. And what we see, I think you'll agree with me, happening more and more is enterprising young Bahamians looking outside of the Bahamas for opportunities. Now, if we ask ourselves why this is, I think you come to the conclusion that it is the result of the fact that our economy is not producing opportunities for our people, generally speaking. I listened carefully to Sir William's defense of the economy, and I don't disagree entirely with a lot of what he said. But I think when we are thinking about fiscal monetary policy, past, present, and future, really what is important is the future. The past is interesting from a sort of academic point of view, and the present is important because we are living it, and in many, many cases with great difficulty. The fact is that there are many Bahamians throughout this economy, not only here in New Providence, who are living what effectively is below the poverty line, in some cases in abject poverty. And on the other side of it, of course, we've got enclaves where there is incredible wealth in the Bahamas. That's quite true. But that is really the answer to why our numbers sometimes look acceptable. Because when you do an averaging of that, it still looks reasonable. But the truth is, and I think we all in this room must know this, that our economy, certainly for, I guess, at least a decade now, but probably much longer than that, has been slowing down and grinding to a virtual halt. And the question then becomes, in my opinion, how we look at revamping the policies and the underpinnings of which have guided the economy up to this point in order to create an economy which is going to more adequately suit the needs of the Bahamian people. As Sir William said, the protectionism, he didn't use that word, but that's really what he was referring to, in fact. The protectionism which we have lived for these decades have become a part of the culture. I listen every day, and over the last couple of days listening to people discussing WTO. And it's clear that many of us don't understand that we are now living in a world which is completely different from what we see here in the Bahamas. There is a video which circulates on social media of the Israeli Prime Minister a couple of weeks ago making a presentation to a group of young people in Washington and sort of explaining the Israeli economy. And I would urge you to find it if you can, because it is amazing. He pointed out, I think there were 20 of the world's most innovative companies. The world's most innovative companies. Of course, United States, Germany, Japan, China even, and so on. All of them research centers in Israel, employing thousands of people. Now, unless we understand that the old economy is finished, it can't serve us any longer. Unless we understand that, we continue to praise this system that we've got here, which, just kind of keeps us hobbling along, but in fact does so much harm, I would argue, to the vision and the ambitions of young Bahamians that it's really quite tragic. And again, if you listen to the commentary on the radio, what you have is our people defending this and wanting to think that what we need to do, a la Donald Trump, is just build some more walls around the economy and we'll be fine. I hope that during the course of this discussion this evening, we may touch on some of the issues which really are essential or central to this issue, how we can reform this economy. We have now to take a serious look at issues such as dollarization. We have to look at a faster pace, I would argue, of removing exchange controls. And please don't misunderstand me. Yes, I mean, for many decades even, we felt and believed that it was important to protect the welfare of Bahamians by having some of these measures in place. But my point is this, really. The world has changed. And unless we figure out how the Bahamas needs to change to be able to compete in this new world, as I said to a friend of mine this afternoon, we were talking about this, we very soon will find ourselves in the same situation as one or two countries, even in this region, that we normally consider to be pretty much basket cases. And I'm not exaggerating when I say that. I believe this is absolutely where we're headed. Now, the last thing I'd like to say is that it's really an example of how we have gone wrong, actually. A lot of the focus so far, the presentations has been really on monetary policy, but fiscal policy is also incredibly important. Thing is, and I hope we get a chance to talk about this a little bit, but what we in the Bahamas have failed to do is to put in place institutions or the institutional arrangements which protect against the government of the day abusing fiscal arrangements. And this is a very serious problem. This is a very serious problem. And let me say, because I'm sure that some will not understand entirely or will choose not to. I am not pointing a finger at any particular government. This is across the board. We have all behaved badly. I haven't brought the numbers with me tonight, but it really wasn't that long ago when the Bahamas had virtually zero public debt. Within this where are we? Last century. Something like about 60 years ago. And if you look at it today, we're as you all know, we're maybe above 80% and still going strong. This is not healthy. This is not the way to build an economy. This is not conducive to the kinds of environment which enables businesses to thrive and so on. And so we have really a great deal of work to do. Thank you very much for listening, and I look forward to commenting.
Thank you very much, Mr. Francis. And of course, the only and distinguished female in all the leadership group, and the most recent, other than the current governor of the central bank. Ladies and gentlemen, please welcome Mrs. Wendy Craigg.
I could just say amen to everything that's been said, because they've taken it all in some way or the other. But I must say that it's quite a pleasure to share the stage with my fraternal central bank governors, whom I've had the pleasure of working. I've worked with all of them throughout my career at the central bank, and I certainly admire them for the contribution they've been making in the policy space, and for the their continued contribution to policy making in general and to the national dialogue on these matters. As you've heard from them, fiscal and monetary policy are certainly two very important elements that support and influence growth and development, the government's use in the central bank. And in the Bahamian context, certainly whenever you speak about monetary policy, you cannot divorce it from the exchange rate that we have, the parity with the US dollar. And because this has been in place since 1973, and of course you cannot divorce it from a discussion of exchange controls. And I'm sure you're going to hear a little bit much more about this as the night continues. And it's really this linkage which underlies the central bank's policy, primary statutory objective, which is to maintain stable domestic credit conditions in the economy that would support this peg. And as you might have heard and you would hear from time to time, this is why the central bank has such a concern about domestic credit expansion and about the level of liquidity in the system. You would always hear the central bank talking about liquidity, how much liquidity is in the system, because that represents the amount of loanable funds that the banks have at their disposal to extend credit. And whenever credit is extended, because we import just about over 70% of our goods and services, you lose reserves. And it is the level of reserves that are utilized to defend this peg. Retrospectively, just looking retrospectively, I believe that the central bank has done very well with the instruments, the policy tools that it has at its disposal to manage credit and liquidity. You would have heard about many episodes that the central bank had to utilize these policy instruments back in the 80s, the 90s, especially when we were confronted with challenges. And most of those challenges came because we were experiencing a contraction in growth. And whenever you experience a contraction in growth, there's less money in the system. And when that happens, and if you cannot get a control of credit, you would then lose more reserves. So this has been really the main actions and activities of the central bank. I think, and you've heard about the perspective looking forward, I think as long as the exchange control arrangements remain in place, the one that we currently have with the fixed exchange rate, the central bank's main concern will continue to be maintaining stability in domestic credit conditions. But you've also heard that we need to begin to open up a bit more. Certainly there is a lot of clamoring from the private sector for the ability to make investments overseas, the ability to obtain foreign currency just for general use without being restricted. Now, some of us have different views on that. But generally, there's been a tendency in the past for the perspective to be taken that such a move has to be gradual. You cannot just open the floodgates, because you want to be able to maintain confidence in the currency as well, without destabilizing the domestic economy. But certainly I support what the central bank is doing, continuing to do, with the gradual relaxation of the exchange controls. I believe going forward too, you would tend to see there's a more active role to be played by the central bank in the way it interacts with the domestic market in terms of more use of what we would call indirect policy instruments. Being able to influence the level of the money supply by buying and selling of government paper. And I believe that we will see a little bit more of this, and the central bank has already indicated its intent to actually put in place the arrangements that would allow for this through introducing at some point in the future, the near future, an auction mechanism for selling government bonds. Because right now it's an arrangement that is used. It's not the where customers who come in and bid for what they want. So we perhaps see a little bit more activity there. And then, of course, the movement of the government paper to BISEX will also help to provide an environment for this to happen. Now, when it comes to domestic fiscal policy, I think it's fair to say that the stance that the government has taken, and successive governments, could be characterized as expansionary. We've all seen, I think with the exception of 1 year, and it might have been 1974, we've had fiscal deficits in every year. And it's not a bad thing, because that's what the government does. It uses its policy tools, expenditure, to actually have an important influence on economic growth and development. And as a young nation back then, that was the right thing to do, to spend, but within limits. But over the years, what we have seen is a sharp and persistent rise in the deficit. And this has led to a rapid accumulation of debt. When you look retrospectively, we've come from from budgetary outcomes in the 1980s and 90s, where the fiscal policy that was being pursued held the overall deficit to about 1.4% of GDP, and that's very low. And debt was average a mere 12% of GDP. Could you imagine that? 12% of GDP. But fast forward to the current situation, where we have deficit in excess of 5%, and we have a debt to GDP ratio, not 80, but just below 60%. Okay? So where we find ourselves today, though, didn't happen overnight. It did not happen overnight. And one could attribute this to the pattern of high fiscal deficits, to the fact that there's been very little adjustment on the expenditure side. Very little. And you can imagine that in difficult times, what we have here in the Bahamas is, on the expenditure side, you have the bulk of your expenditures for emoluments. So when there's an economic downturn, there are rigidities to making changes there. And then in the past, on the tax side, most of your taxes are tied to trade. So if the economy is tanking, you can't do anything to raise revenues. So the brunt of the adjustment has been through debt accumulation. And that's what we've experienced over the years. We've not made any adjustments in expenditures. And you would even see, after the VAT was implemented, this continued. Okay? It continued. So this is something that we know, and the VAT was an important inflection point when we tried to move from trade-based, at least spread the risk from trade-based taxes to more service-based taxes. And then what we also experienced is the country paid for this, because we went through several downgrades in our ratings, where I think we went from an A3 in 2007 with Moody's down to the lowest investment grade in 2016, which was Baa3 rating. And then for the Standard & Poor's, we actually lost our investment grade with a BB plus rating. I think everyone would agree that we cannot continue this way. because it's both unsustainable and it's really not supportive of macroeconomic stability. And I do believe that what the government has done most recently is a start in the right direction. And I speak here about the introduction of the fiscal rules that and that came in place with the enactment of the fiscal responsibility legislation. I believe this sets a new framework for all governments now to strive to ensure that we achieve sustainability in our fiscal position. I think it was Governor Smith who mentioned that even with the best of situations, we still have risks that we have to mitigate. Because the minute there's a downturn in the economy, the minute there's a hurricane, it throws the best of plans into disarray. And we saw this happen many times in our economy. And the most recent time was with Hurricane Matthew, when the government had to do counter-cyclical fiscal policy. It had to spend. But back then we had the fiscal space, but we've exhausted all of that fiscal space now. And this is why it's very important for any fiscal plan of the government to include a disaster relief fund. It has to happen. We have to find ourselves with the fiscal space to be able to make contributions to this plan. This is something the IMF has represented to us, that this fund should be around 2 to 4% of GDP. Now, could you imagine what the amount of that is? That's in excess of $250 million on the low side, the 2% side. So in order to be able to collect and to amass all of this, it will take a number of years. Because half of 1% is like 60 million. And if we are still confronted with large deficits, it will take us some time before we have that fiscal space to be able to put these funds aside. But that is something that we must do. And of course, any fiscal strategy to deal with the future will also have to look at the expenditures. In the last few years, couple of years, there was a lot of pressure as well from the state-owned enterprises. That needs to be addressed. You know, the government has not used reconstruction or looking at privatization as a policy strategy. I mean, we've only had one element of that with BTC. But it is necessary to at least try to move the state-owned enterprises towards more cost recovery so that they can be more self-sustaining, and also have them adopt more private sector oriented operational model for efficiency. The revenue side, I'm sure we will see reforms there as we move towards the WTO. That will require a look at the composition of our revenues, because there's still a large proportion that is from trade taxes. The government will also have to look to ensure the appropriateness of the revenue for governance, for modern governance. Is it sufficient? Do we have the right model of taxes? And all of the issues about intergenerational fairness, efficiency, those are things that we would have to look at. So I think I will stop there, because as we approach the exchange and the dialogue, I'm sure we'll be getting into a lot more of this, and you'll hear some very interesting perspectives from the governors. Thank you.